with our financial algebra stock bar charts, and I have the wrong book, hold on. And what they are. When they present stock market data on like financial websites, they don't always list them. You know, if in the paper they tend to list it, you know, in columns like spreadsheets, but sometimes they do these charts. Okay, so a stock chart is a basically a graphical presentation of stock data. Okay, this is a stock bar chart, and this is one of the most common. Okay, now it can either look like this where it's a straight line, or sometimes it would be like a rectangle. Sorry. A rectangle with a little tail sticking up at the top, a little tail sticking down at the bottom, and then these parts sticking out of the side. But whether it's a straight bar or it's a rectangle, it means the same thing. So what you get is that the top of, sorry, I lied. There's no part sticking out at the top on this kind. That's the other kind. So it'll look like this. It'll be a complete rectangle with a part sticking out of the sides. Okay. The top of the rectangle is that day's high, or the top of the line. The bottom of the rectangle, or the bottom of the line, is that day's low. And then these parts sticking out at the side, the one on the left is always the open, and the one on the right is always the close. Okay, so when we look at this, each of these represents a day in this particular chart. Sometimes they do it by hour, because so many stock transactions can happen in an hour that they can have like a bar per hour with a high and a low. And so here's the stock. It opened really high. It closed lower, right? So that stock actually went down that day. Here it opens high, it closes low. Here it opens low and it closed high. And then this was the highest it was that day and the lowest it was that day. Now, if you're given an actual one, there'll be a column over here with values. Then this bottom part of the chart, this is how many stocks were actually traded that day. So on this day, there were more stocks traded than on this day. And then again, there'll be some chart over here. It's usually in the millions, but it might be thousands, but typically millions. So this might be like 300 million, and this might only be like 40 million or something. The stock bar chart is for Bank of America. Each one of these bars is an individual day. Now, if you look at theirs, they're also color coding, which is really common with the next kind of chart we're going to talk about, which is a candlewick chart, but sometimes they color code the bar charts also. All of the red lines, if you look, the opening is higher than the closing. So every time it's red, the stock actually lost that day. Every time it's green, it actually went higher. So if you look at this, there's a lot more red than there was green during this time period. This is a 3-month time period. These are the value of the stock. So if you look, this stock is not a very expensive stock. It's been down here around $18, $19 a share, and up here at the highest, it's like $35 a share. That's not a real expensive stock. Some stocks are, a couple $100s a share. So if you want to let's look at one of these days because it's easier to see. So I'm going to look at September 16th. That's this green line right here. It opened at 25, which was also the day's low. And it closed, well, almost 30, maybe 29 and 75 cents or something. And it went just a little bit higher than that during the day. You can see there's just a little tiny bit up there. That's how you read that. Okay, so we're going to look at these questions and we're going to have to flip back and forth because your picture on your notes is awful. Okay, so which day had the greatest high price and what was that price? So we're going to go back to here. Here's the tallest one. Yeah, so it's September 8th. So, and then what was that? We're talking about the greatest high price. So that's way up here, which I don't know if you can see, but that's 36 actually. Because see here, 35 is at this white line right there. So 36 is going to be the next block up. So it was $36. Okay. We want to find out which day had the very, very lowest price. That's this day right here. So that's July 15th. Did you see that? July 15th. Oops, wrong way. And that price was below 19, so maybe 18. It's about 18. We're not sure exactly. So it was about $18. For the highest closing price, the closing price is this bar over here that sticks out to the side on the right. So we're looking for that bar that's the highest. See, our highest price didn't have the highest closing price necessarily. We need to just see, is there anything else higher than that line right there? No. Okay, so it did have the highest closing price. That was September 8th again. And that price was about $34.50, give or take. And then the lowest closing price right here, which is our July 15th again. And I'm gonna guess that that was probably about 18 and a quarter, because it looks about a fourth of the way between the 18 and the 19. There's not supposed to be an M on the end of how, so we're just gonna get rid of it. Okay, so about how many shares of stocks are sold from September 8th until the end of the chart? So September 8th is right here. So that's probably about 160 million. So we're going to do 160. And then September 9th is just over 100, so I'll just say about 100. September 10th is just under 100, so maybe like 90.
Does it usually have numbers on it though?
Here? No, it has the bars across, and it's an approximation because they can't actually accurately graph how, like to the exact number, how many millions are anyway. So it's going to always be an approximation. So here we're at about 100 again. Here we're down at about, I would say, 70? Close enough. Then we jump all the way up to almost 300 million, which is, now, this is bought and sold, right? And look how low, like it was way up high and then suddenly it went down. I'm going to say that this is probably sold. Like people jumping ship off of Bank of America. Oops, wrong way again. Then we come here, and both September 16th and 17th, it was about the same. So I'm going to say that's about 175 for each of those days. And then I am going to cheat. So there were about So there were about 1,170 million transactions just between September 8th and what was that last day? September 17th. So over 9 days, there were 1,170 million transactions. Chart. This is called a candlestick chart. I kind of like the candlestick better. The top of the rectangle is the opening, and the bottom of the rectangle is the closing, and then you get a line between the high and the low. Now, of course, if you have like a candlestick like this, your low was your close, right? But you always get, it's really easier to see your opening and your closing, I think, this way, because you have the big block that shows it. Oops, that's not what I meant to do. And why is it called a candlestick? Well, because it looks like a candle stick. Okay, so this is called the real body, this part right here. If you have one color, and it can be any two colors chosen. If you have one color, here it opened higher than it closed, and then the other color will indicate that it closed higher than it opened. So a lot of times they use red and green. Red would indicate that it lost money, and green would indicate that they gained money. But they can use any two colors. It just depends on the institution that's creating the charts. But they'll say, you know, there'll be something that says, you know, which it is. Okay, so we're using the black and white. Now remember, black means that they lost money. White means that they gained money. Okay, here we have Microsoft. As you can see, doesn't this look easier to read, just even visually, than that other one? Here's the volume on this side. No, sorry. Volume on this side, price on this side. Microsoft is an expensive stock, right? But look down here, it went down to like $90 a share. But it's normally up here in the hundreds of dollars a share. So what we have is, like, on this day, on the 1st of this month, whatever month this was, I gained money. I opened at maybe like $200 a share. I closed at like 220, yeah. My high though was all the way up to 240. Here I lost money. I opened at a little like 220 or so, 215, and I closed down here at like 185, 190, something like that. My volume, these are in millions. So Microsoft has lots of shares. Like the lowest volume was 22.5 or almost 22.5 million. The highest volume was way up here this day that it was dropping, and you can see how it's dropping. It dropped for a few days. Somebody noticed a trend and dumped the stock, which caused it to what? Keep dropping, so more people dumped it. And that, I mean, that's how it works. If somebody notices a trend that it's starting to go down for whatever reason, and then a bunch of people dump their stock, it causes it to plummet even further, which is, you know, when you watch the movie about this fall of the stock market, that's what happened. People saw that it was falling, and so they bailed out, which just made it fall even further. And people and stock market, if it's dropped $176, what's going to happen? More people are going to sell, which means it's going to drop even more. Now, if you had been watching the market and you maybe don't own Microsoft stock, but you see this trend right here, right? And you're looking at stock that's up around $280 and you see that it's down here around $90, and you can see that it's maybe going to drop even a little lower. But you know Microsoft. Microsoft is in over half of the computers in the world, right? Or at least over half in the United States, because more people own PCs than Macintosh. And very few people that own a PC use Linux. And there's Microsoft Office and all these things that Microsoft puts out, and we all know who Bill Gates is and everything. This would be a good time to climb aboard the Microsoft ship when you see a trend like this, because likelihood is it may continue to fall from where you bought it, and you might go, oh man, I could have gotten it for cheaper. But eventually it's going to curve and it's going to come back up, and then your stock is going to be worth a lot of money. At which point, when it gets back up here at like $300 or $270 or something, you could turn around and sell that stock that you paid $90 for, and you've tripled your money. You might have to wait, but eventually, it's a company, Microsoft. It's Microsoft. Eventually, it's going to have an upswing. You know, it's not like Joe Schmo's Boots. You know, you don't know anything about that company, right? This is a company that you know about. So that's another thing with watching the stock market. You watch even stocks that you don't own, looking for those little dips where you can get it for really cheap, knowing that it'll come back up later. Okay. Now, this graph, it was really kind of easy to see what's going on. However, when you're dealing with large quantities of transactions, and sometimes, like I said, they do hourly graphs, and so you get just a bunch of bars across the graph, like, because there's bars for every hour in a day, and it's very confusing. There's a lot of information, and so when that happens, they use something called smoothing techniques or simple moving averages. Well, the smoothing technique basically, it reduces the impact of price fluctuations. Simple moving averages, we'll talk about those, but right now we're talking about the smoothing techniques. Reduces the impact of price fluctuations, because if you did like a line graph of the price fluctuations that are happening in stocks, you're going to get something like, you know, it's really hard to look at. The smoothing techniques will make it more like this. And the idea is that this allows you to more easily see the pattern of the trends in the market, because you're not looking at a bunch of jagged lines, and sometimes they're like, you know, really weird like this, and then you can't see the pattern as easily. So the smoothing technique will take these really weird jagged lines and make it a nice curve that you could see. Okay, one of the techniques is a simple moving average, and what the simple moving average does is it calculates the arithmetic mean, which is just the average. That's all that means. So it calculates no, it's not just the average, it's the average closing price, sorry. Because that's really more important than the opening price. Okay, and the arithmetic mean is just the average. We use the simple moving averages. They're lagging indicators because they're using past data. You can't calculate a simple moving average for today. You have to look at, you have to go kind of in the past to be able to take these averages, because today is still changing. So it's a lagging indicator. But you can use data up until yesterday, right? So you can go back a month or a week or whatever, and so you can use data up until yesterday to make a decision for today. Okay, so first of all, SMA right here stands for simple moving average. And you have, they can be 5-day SMAs, 10-day SMAs, 21-day SMAs. And what they do is that's taking the averages in 5-day clumps. Okay, so our first clump is going to be days 1 through 5. Our second clump is going to be days 2 through 6. So we move 1 day, but we still take a 5-day clump. Our next clump, well, if it's a 5-day SMA, it's 5 days. So it'll say what size it is. So you could have a 10-day or 20-day or how, you know, it doesn't matter. But it will say. Then we have our next one is 3 to 7. And then, you know, the next one is 4 to 8. You guys get the idea, right? You just keep going 1 day down. All right, so first we're going to do it the long way. So we take the closing price. Hold on. Okay, so we're going to take the first 5 days. So I've got 35.02 plus 35.01 plus 34.65 plus 36.09 plus 35.32, right? And I divide it by 5 because that's how many days it was. So I'm going to pause this. This is my average for this first clump, right? The first set of 5 days is 35.22. Then I do my second set of 5 days. So then I start at 2 and go through 6. So I have 35.01 plus 34.65 plus 36.09 plus 35.32 plus 35.50. And I divide that by 5. Okay, which I get 35.31. And then I do days 3 through 7. So 34.65. then I divide that by 5. Which gives me 35.32. Okay. Now, okay, this was days 1 through 5, right? This was days 2 through 6. This is days 3 through 7. So days 4 through 8, days 5 through 9, and days 6 through 10. And then I'll be done, right? Because 10 is my last value. So if I do the same process again, days 4 through 8 is 35.55. Days 5 through 9 is 35.74. And then days 6 through 10 is 35.89. So these are the points that I would graph. Now, I think, yeah, I did, okay. So I'm going to take this data as soon as we're done writing. All right, so first I'm going to graph our closing prices on the day, like our normal, what the graph would look like if we just graphed a bunch of closing prices. I'm going to do this in blue. Okay, so on day 1, we're just going to say day 1 is about right here. Huh. That's interesting. Hold on one second. Okay, so what I have is if I go to day 5, it's 35.32. So if I come up, 35.50 is here, 35 is there. It's a little more than halfway. Day 6 is 35.50 exactly. Day 7 is 35.03, so I'm pretty much essentially right at 35. Day 8 is 35.79, so that's almost up to 36. Day 9 is 37.07. And day 10 is 36.05. And then if we connect all these lines, you get sort of a jagged picture, right? Well, for our smoothing averages, what we're doing is day 1 through 5, we graph at the 5. Okay? So this is our value of 5. So it's 35.22, so that's probably here-ish, right? Because this line would be 35.25. This is our day 6. So that's 35.31, which is probably there-ish. That would be our day 7. Because you see how we're graphing the last number? In the simple moving average, we're graphing, so we're doing day 1 through 5 gets graphed on day 5. Days 2 through 6 gets graphed on day 6. Okay. Day 7, well, that's 3 through 7, so that's 35.32, which is, again, kind of here-ish. This would be for day 8, is 35.55, so that's just right above there. Day 9 35.74. So that's about right there. No, sorry. It's just below there. And then day 10 is 35.89. So that's like here. And you connect those with a curve. And you can see here I've got a bunch of jagged stuff going on, and I might go, oh my gosh, look at that big plummet. I don't want to buy this stock. But if you look at the smoothed average, you can see that it's steadily increasing. So this stock is going up, even though it had this one like plummet right here. It's in general, and a plummet right here too. But in general, this stock is raising in value. So that gives you a better idea of whether or not it's a worthy stock to purchase. So we did all this work. And we had to do all that work again and all that work. Well, there's a shortcut for this. It's called using the addition and subtraction method. And in the book they had given you a bunch of letters to tell you how to do it. So I'm not going to do that. I'm just going to show you what to do. And hopefully. So what we do is we're looking for the 4-day SMA, right? So we're going to go in groups of 4. So I'm going to take the first 4 numbers. Okay, and I divide that by 4.
Where do these numbers come from?
Right here. They're just given to us.
Oh, I thought it was one in the chart.
No, they're just given to us as like those would be the days closing prices for some stuff. The average for days 1 through 4 is 120.50. Okay. Then I want to find days 2 through 5. Here's where it gets a little strange. Okay. I'm going to take the average for all 5 days. I'm going to subtract the first day divided by 4. And I'm going to add the 5th day divided by 4. So what this is actually is 120.50 plus, look at that, 121.
125.
Oh, sorry, no, it's 124. 124, thank you. 124 over 4. So this is negative 121 plus 124, so that's actually 3. Which is actually 75 cents. So it's actually 121.25. Or I could have converted these to decimals and then done the subtraction and the addition. Okay. What I did there is I took away 121 and I put 124 on the end, because if we look back at when we did this the long way, see how we had 3502, then 3501, 3465. We took the 3502 off, so we start here and then we tack on a 3550 at the end. So basically I'm doing that process but without rewriting and having to calculate and add everything. This is just a shortcut. And if you like this method, do this method.
Wait, is that supposed to be a addition sign at the beginning?
Here?
Yeah.
No, it's a subtraction because I'm taking away this one.
So for days,
So I took this one away. That's what this came from. And then I added day 5.
so for the next one, you would do 121.
25.
Minus.
So if I do days 3 through 6,
Gotta be 120.5.
right? Because I take this right here.
Or using.
I use the previous. And then I'm going to take away day 2,
Okay, and then you add 120 on there.
which that's day 2, and then I add day 6. So this is days 2 through 5. I take away day 2 to start at day 3, and then I add day 6. So this is going to be, I have negative 122 plus 128, so that's 6 over 4, which is $1.50, right? Okay. So that was day 6. So the last day we would have is day 7. So I'm just going to kind of try to squeeze it in up here. If you guys have room in between, you can write it on the bottom or something. So days 4 through 7, I'm going to take that 122.75. I'm going to take away day 3, which was 120 over 4. Here's day 3. And then I'm going to add day 7. And it's always over, so if it's a 4-day SMA, so it's over 4. If it was like a 6-day SMA or something, it would be over 6. So this is 122.75 plus, again, 6 over 4. So that's 122.75 plus $1.50. So that's 124. Is that 124.25? I went cars, what? Crossover vehicle? No. Okay. What happens at the crossover is you're taking and making on the same graph moving averages for 2 different intervals. So you might have like a 4-day SMA and a 10-day SMA, and then you put them for the same data and you put them on the same graph, and the pictures are going to look different. So what happens is your fast moving average, this is the one with the smaller SMA. And your slow moving average has the larger SMA, or smaller time interval. So for example, this might be a 4-day, and this might be like a 12-day. So the 12-day is going to move slower, and the 4-day moves faster. Okay. A crossover occurs okay, so it has to be, okay, it doesn't really matter which one. Okay, so when one of these, so one time interval, overtakes the other, or crosses. Okay. What's the point of crossovers? They indicate when a stock trend, when a trend reversal could happen. Okay. So if the fast moving graph, you know, the fast overtakes the slow, so then the fast crosses over and is now above the slow, that's a good time to buy. Buy has a U in it. Or if the slow overtakes the fast, like crosses and goes above the fast, that might be a good time to sell. stock bar. Here we have all the
Is
stock bar.
Is all of them mixed in one?
Yeah, this is all of them mixed in
I'm
one.
wondering why it's looking pretty.
So we've got the lines going up and down. These are the actual stock bar graphs of the day. And then they did this black line, and I know it doesn't show up as black and green on yours, but it's black and gray. So the black line is the 10-day moving average. So that's actually the slow one, right? So this is the slow. And this one is the fast, because the time interval here is less. Okay, so the green one is the fast, and you can see like this one is kind of like,
How do you know this is fast?
because it's got the shorter time, because this one's going 5 days and this one's going 10 days. Does that make sense? But you can even kind of tell from the picture, because like you see the black one's sort of meandering along, and then the green one's more jagged. Not as jagged as the actual,
A lot more.
yeah, but it's, yeah, more ripples. So what we do is we look right here. See how here the fast is overtaking the slow? So when the fast goes above the slow, and I want to say this correctly. Right, so when the fast goes above the slow, so right here, this would have been a good time to buy.
That's called a crossover.
It's called a crossover. And look right here, the fast, the slow overtakes the fast. That might have been a good time to get out. So, but then we come back here and the fast is overtaking the slow again. And as you can see, we've got a trend now where it's continuing to rise. This right here would have been an excellent time to buy. Because we've got the fast overcrossing and then we've got a continued upslope.